2016 has been an active and successful year. Against an uncertain backdrop, I'm pleased that we've delivered another positive set of results, consistent with our long-term targets. This morning we reported strong earnings growth of 8.6%, thanks to another stellar year for our premium outlets portfolio and consistent rental growth across the business, with like-for-like net rental income up 3.2%. NAV per share increased 4.1%, largely as a result of strong income growth in outlets and our new Ireland business, which, together with yield compression in France, offset some outward yield movement and value decline in our retail parks portfolio. And I'm pleased to report that the board has recommended a full-year dividend of 24p per share, a 7.6% uplift on the prior year, further underlining our confidence in the business. Now, despite the political and economic uncertainties that dominated much of the year, we've not seen any discernible impact on retailer demand for space. This is largely a result of our strategy to focus on developing and owning prime retail assets in growing consumer markets. Leasing activity has been strong, with momentum during the first 6 months of the year mirrored by the performance in the second half. During the year, we secured £24.9 million of income, with principal leases secured at 6% above ERV. We were delighted to introduce major new brands, including the new Apple store in Marseille, Smiggle's debut in Scotland at Silverburn, and the first Five Guys in Ireland at Dundrum. Our product experience framework continues to be deployed successfully across the business, with a number of trials resulting in full-scale rollouts, including our click and collect partnerships with Doddle and Collect Plus, where Brent Cross and the Oracle registered within the top 3 destinations for the service in the UK. Demand from occupiers at our retail parks also remains strong, notwithstanding valuation declines. This was particularly evident across our key fashion and homeware categories, resulting in exceptionally low vacancy rates right across the portfolio at the year end. 2016 saw the opening of 2 major developments for Hammerson. Victoria Gate, our aspirational retail destination adjacent to the luxury Victoria Quarter in Leeds, opened its doors for the first time in October. The scheme, anchored by the largest John Lewis outside of London, welcomed major new brands including Aspinall, Calvin Klein, Tommy Hilfiger and Anthropologie, and quickly gained a reputation as the Knightsbridge of the North, welcoming an astounding 3 million visitors in the run-up to Christmas alone. We also opened our dining and leisure-led development, Watermark, in Southampton in December, and it features Southampton's first Hollywood Bowl and a state-of-the-art Showcase Cinema Deluxe. Now, looking ahead at the current year and in response to the strong levels of tenant demand we're experiencing, we're already on site with a number of retail park developments, including Swansea and the second phase of our Elliotsfield development in Rugby, with further small-scale extensions planned across the portfolio later in the year. And in line with our strategy to further upgrade our shopping centres in France, we're progressing a number of extension opportunities and other asset management initiatives. We're making good progress with our major London developments at Brent Cross and Croydon, with early enabling works at Brent Cross scheduled for later this year ahead of an anticipated start on site in 2018. We've been particularly active with acquisitions and disposals in 2016, with the continuous aim of upgrading and maximising the performance of our portfolio. We further extended our exposure to the fast-growing premium outlets market, adding to our stake in Value Retail and acquiring 5 more European outlets through our VIA fund. And that takes the gross asset value of the VIA outlets portfolio to over €1 billion across 10 assets. In line with our strategy, we plan to deploy asset management initiatives to lift the quality of retail brands, increase sales densities and improve customer services and amenities. During the year, we also completed major acquisitions at Grand Central in Birmingham and our new platform of retail assets in Dublin, in partnership with CPP, IB and Allianz respectively. Ireland remains Europe's fastest growing market, and we're excited that we're now in a position to integrate the assets by introducing asset management initiatives and elements of our product experience framework, which are proving so successful across the rest of the portfolio. To part fund these exciting new growth drivers, we've recycled capital from lower performing areas of the business. Achieving this ambitious sales programme against the economic uncertainty which persisted throughout 2016 is testament to the skill of our team and the underlying demand for quality retail property. The combined proceeds achieved as a result of this activity amounted to £635 million. We also successfully refinanced over £1.2 billion of borrowings during the year to support our expansion into Ireland and lock into longer-term low cost of debt. Looking ahead, we will continue to pursue an active capital disposal programme. So whilst the outlook remains uncharted due to the consequences of Brexit and our retailers experience stronger cost headwinds, we continue to see positive drivers in consumer, occupier and investment markets. Against this backdrop, I'm confident that our differentiated portfolio of high-quality retail destinations will continue to deliver market-leading returns for our shareholders.